Like a lot of great things, from the Holy Trinity to hockey periods, it comes in three. Now, the balance sheet's no different. You have assets, liabilities, and equities. Before we dive into what's equity, let's first talk a little bit about, remember, the balance sheet. You see, balance sheet tells you what you own and kind of how you paid for it. The liabilities tell you who you owe and what you owe them. But the equity portion, that's the other way they pay for stuff. You see, there's two different ways to usually pay for an asset. One is you pay for it using a loan, or two, you pay for it with your own money invested into the company or outside money invested into the company. That's called equity. You see, equity is either what you personally have invested into the company by saying, I took my money from my personal banking account and I put it into my business banking account, or it's money from outside investors who say, we would like to buy a portion of your business for XYZ amount of dollars. That's what makes up the equity portion of the balance sheet. For example, when we started this company, the company had no money, and we still had to buy some stuff like a website, camera gear, things like that. So what we did is we took our personal money from our personal bank accounts and we put that into a business bank account just for that. That investment into the business bank account was equity. And from that equity, we were able to buy assets like cameras and websites. That's a very simple example. A little bit more complicated example would be something like Tesla. You see, Tesla, their stock price has really rocketed. And we will talk a little bit about stocks later on, but for right now, just understand that stocks is usually equal to equity. So when the stock price goes up a lot, unfortunately, Tesla doesn't get all that money. They get what they sold the stock was whenever they first sold the stock, which we'll say, just for this example, is going to be $10. So we'll say that Tesla sold stock for $10 and now it's worth $100. Well, Tesla would like to sell more stock at $100 so they could pay for more assets. So they do what's called the second offering. And they say, oh, well, now our stock is worth 10 times as much as it used to be. Let's offer more stock and give away a little bit more of our business so that we can buy more factories and more supplies so we can build more cars and grow faster. And so Tesla did really rough math that said, hey, instead of giving a loan, let's just sell more of the company so that we can grow faster that way so we can actually build some things we want to build. Both these are examples of equity. One came from us as a business owners and operators. The other one came from outside investors into Tesla. But both classify as equity on the balance sheet. If equity is just money from investors, doesn't that make it stock? And I'll say, to be completely truthful, it's a little bit complicated. However, just like the square and rectangle rule, they work about the same. You know the rule where every square is a rectangle, but not every rectangle is a square? Same kind of thing here. Every stock is a part of equity, but not every equity is a stock. You see, equity is made up of two different things. One, the money given by the owners, whether it's the original founding owners or investors who now own a portion of the business. That's one portion of equity. The other portion is what's called retained earnings. And retained earnings is money the business has made and kept. So earnings from the business that they've retained. Kind of makes sense, right? So yes, the stock you buy in the stock market for your retirement account or 401k or something like that is technically equity. However, there's also a lot of other types of stock, such as partnership interests, preferred stock, things like that, which are not really part of normal stock that you buy in the stock market, but are still considered equity. And of course, there's always the retained earnings that will be considered equity as well. So yes, stock is equity, but not all equity is stock.